Hello and welcome. Today we're diving deep into the financial engine that takes millions of ordinary car loans and mortgages and, well, turns them into investments that are bought and sold all over the world. We are going inside the structured finance model.
Think about it for a second. It's a little weird, right? You make your payment to a bank every single month, but somewhere out there, a pension fund or an investor is actually getting a tiny slice of that payment. So how on earth does that connection even happen?
Well, it happens through a process called securitization. And it's not just for mortgages. We're talking car loans, corporate debt, you name it. It is a really fundamental part of how money moves around the global economy today.
But for any of this to work, everyone involved, from the banks creating these things to the investors buying them, they have to trust the numbers. And that trust, it's all built on one thing: a really sophisticated, incredibly detailed, and robust structured finance model. And that is what we're breaking down today.
Okay, so before we get into the guts of the model itself, we first have to get our heads around the big picture, the process that it powers, securitization. At its heart, it's kind of like financial alchemy. You take thousands of individual loans, things you can't just easily buy or sell on a whim, and you magically transform them into bonds, which, can be traded easily on the open market.
Here's how it works in 3 basic steps. First, a bank bundles together a huge pool of similar loans. Next, it sells that entire bundle to a totally separate legal entity, something called a special purpose vehicle, or SPV. This is important because it gets the loans off the bank's own books. And finally, that SPV issues bonds to investors, and the money flowing in from all those original loan payments is used to pay those investors back. Simple, right?
So what kind of loans actually go into this box? All sorts, really. Mortgages get bundled up into what are called mortgage-backed securities, or MBS. Car loans and personal loans, they become asset-backed securities, or ABS. And even huge corporate loans get pooled into what we call collateralized loan obligations, or CLOs.
And this brings us to the most important question of all. You have thousands of different borrowers, all paying at different times. Some might be late, and sadly, some are going to default. How can an investor possibly predict their return in all that chaos? How do you even begin to measure the risk? The answer? They do it with the model. So now, let's pop the hood and take a look at the core components that make this financial engine actually run.
The best way to think about a structured finance model is to see it as 5 core interconnected building blocks. Each block answers a very specific question, and when you put them all together, they give you a complete picture of an investment's risk and its potential return. So let's break them down. Okay, block number 1. It all starts with the foundation, the asset pool. This is just the raw data for every single loan, its balance, its interest rate, its term. But data only tells you what happened in the past. To predict the future, the model has to layer on some crucial assumptions. Things like, what percentage of these loans do we think will default? How many people will pay off their mortgage early? These assumptions are basically the fuel for the whole engine.
The second block is the cash flow engine. This is the calculator of the whole operation. It takes all that loan data and those assumptions we just talked about, and it just churns out a projection, month by month, of exactly how much cash is expected to flow in from all those thousands of borrowers.
So once the model projects the cash coming in, the next vital step is figuring out how it all flows out. And that is handled by the waterfall. Now, this is a super strict hierarchy of who gets paid first. At the very top, you have fees for lawyers and servicers. Then the safest, most senior investors get their interest payments. After them, the riskier mezzanine and junior investors get paid. Only after all that does the principal get repaid. And if, and it's a big if, there's anything left over, it goes to the equity holders at the very bottom of the pile.
All right, the fourth block. This contains the deal's safety switches. These are triggers and tests that are always being monitored. For example, if losses start getting too high, or if delinquencies suddenly spike, a trigger can be tripped. And when that happens, the rules of the waterfall can actually change, often diverting all the available cash to pay down the safest senior bonds as fast as possible. It's all about protecting them, usually at the expense of the riskier investors.
And finally, we get to the outputs. This is the payoff, what everyone is really looking for. The model spits out all the key metrics: the expected return, the projected repayment date, and crucially, the results of various stress tests. This is the information that people actually use to make investment decisions. And that right there brings us to one of the most important jobs of the entire model, being a critical risk management tool by simulating what happens when things, well, when they go wrong.
See, the model doesn't just run one scenario, it runs tons of them. You have the base case, which is kind of what everyone expects to happen, but then you have the stress cases. What happens if a recession hits and defaults suddenly double? What if people just stop paying off their loans early? The model can answer all of these what ifs just by tweaking the inputs. And this isn't just some theoretical game. Investors do this every day. For example, an investor who holds a mezzanine piece, one of the riskier slices of the pie, might run their very own stress test. As our source material points out, they might plug in slower prepayments and higher delinquencies just to see if their investment still gets paid back within their 5-year target. This is exactly how they pressure test a deal's strength.
So who are all these people using these models day in and day out? Let's take a look at the different players and the very specific questions each one of them is trying to answer. What's interesting is that everyone's looking at the same model, but they're all asking different questions. The bankers who arrange the deal, they want to know the minimum amount of protection they need to make it profitable. Investors, they are laser focused on their downside risk. Their big question is, what are the chances I'm going to lose my money? Then you have rating agencies, and they push the model to its absolute limits, testing really extreme scenarios. And finally, a bank's own internal risk team uses it to see how the deal would perform under the government's official regulatory stress tests. So after looking at the process, the parts, and the players, let's just tie it all together and really drive home why this model is so incredibly essential. When you boil it all down, the model has two fundamental jobs. First, it takes the messy, chaotic behavior of thousands of individual borrowers and translates it into a predictable stream of cash for investors. And second, and this is just as important, it proves how the deal's internal machinery, the waterfall and the triggers, will protect those investors when things inevitably don't go according to plan. It is the absolute bedrock of trust in this multi-trillion-dollar market. And that leaves us with the ultimate question. It's the one question that every single model has to be able to answer. It's what every investor, every regulator, and every rating agency really wants to know. When things go south, can you trace every single dollar through the system? Can you prove exactly who gets paid, who takes a loss, and why? If the model can answer that, it has done its job.